Hi, and welcome back to the Food Fund, where we analyze investing in food, beverage, and restaurant stocks. In this video, we will be evaluating the portfolio performance for January 2025. I made several purchases, so be sure to watch through the end of the video to find out what I bought. Before we get started, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get started. Cue the logo. Let's start off with the market's performance. For the month of January, the S&P 500 gained about 2.9%. Again, we hit new all-time highs after a tough start. January also had an important earnings report. Starbucks reported their Q4 2024 earnings, the first full quarter under new CEO Brian Niccol. Starbucks generated $9.4 billion in revenue versus estimates of $9.32 billion, with earnings per share of 69 cents versus estimates of 66 cents. Great job. More worrisome was that same-store sales and foot traffic both fell 4% and 6%, respectively. Niccol shared his thoughts on his 2025 plans for the company in an interview on CNBC.
Yeah, look, I am really proud of the progress that we made. And, you mentioned some of the challenges we're facing, but I think I've outlined, hey, here are the four key things we're going to do to get this business turned around, right? First, reintroduce the Starbucks brand to the world. Second, we got to make sure our partners are supported the way they need to be supported. It all starts and ends with them. I think this testament of 90% promote within has really resonated with our teams. And then also the idea of making sure that we simplify the process, bring order to mobile order. The third thing we said we were going to do is obviously bring back the idea of a coffee house vibe. Hopefully you saw that with the condiment bar coming back. When you stay in our stores now, you're getting a ceramic mug, some free refills. And then obviously the other thing too is we got to win the morning. And you're starting to see us do that. And that's what I was really excited to see is we're starting to see progress as it relates to our partners being in position, being supported correctly, eliminating some of the noise so that we can get after the great craft, the great quality, and really have people experience, the premium experience of Starbucks. And I think that's what you're seeing start to take hold for the business. Small steps forward, but I love the fact that we're going forward.
I have to say, as a shareholder, I love where Niccol is taking the company, and so did the market. Starbucks share price jumped 8% after earnings. Okay, let's move on to the portfolio performance. I deposited $100 into the account on January 1st, 2025, and at the end of the month, the portfolio balance was $667.28. This means the portfolio lost $8.51 for the month, representing a 1.3% loss for January. The good news is that we lost less than last month. The bad news is that we still lost money. Given the S&P 500's 2.9% return, we lost 4.2 percentage points of alpha by not being invested in the S&P 500. We are starting to see a pattern of trailing the S&P 500 by around 4.5 percentage points of alpha every month. The stocks that I thought would act as stabilizers for the portfolio continue to fall, which adds pain on top of my more volatile holdings. Here I've added a chart to better illustrate the portfolio's performance versus the S&P 500. We started off strong but were falling behind by August 2024. Even still, we were largely paralleling the market until November 2024. I believe the energy regarding the anticipated tech tailwinds after the United States presidential election really catapulted the S&P 500 to loftier valuations. Rather than shift into even more growth, I think maintaining my current portfolio strategy is our best chance to outperform in the S&P 500 over a 5-year period. Since inception, the portfolio has had a negative 5.1% return on a money-weighted basis, while the return on a time-weighted basis was negative 4.7%. Given the S&P 500 10.3% return, we lost 15.4% of alpha by not being invested in the S&P 500 since inception. Again, it is super painful to trail the S&P 500 by such a large margin, but we are getting better each month. Now let's look at the portfolio moves for the month. First, I bought some Celsius, Chipotle, Hershey, and Pepsi on January 2nd. On January 6th, bought more Hershey, Texas Roadhouse, and received that sweet Pepsi dividend. Bought more Texas Roadhouse and Wingstop on January 7th. Bought Pepsi on January 8th, 10th, and 14th. bought Texas Roadhouse and Wingstop on January 17th, plowed into Celsius on January 21st, 22nd, and 23rd. Also bought more Hershey on January 23rd. Bought more Celsius and Hershey on January 28th. Bought Celsius on January 29th, and received a little interest from the cash I held in the account during the month. Clearly, I was focused on averaging down in several of my portfolio positions. Okay, let's take a look at the portfolio positions. Celsius remains my largest holding, with 6.38 shares at a cost basis of $32.36. This position is down a whopping 22.8%. Celsius makes up 23.9% of the portfolio. I have managed to average down in this position, but it still remains a much larger proportion of my portfolio that is ideal. The challenge is that the company looks great in terms of fundamentals, and the valuation is lower than it has been in the last 5 years. The big problem for my portfolio is that my top 3 positions, which account for 59% of my portfolio, are all in the red. It is really hard for the portfolio to perform well under these circumstances. Texas Roadhouse and Chipotle are really the only positions holding this portfolio together. I have added to both positions but am actively avoiding throwing them into the red. Again, this month I deployed nearly all of the cash and have only 14 cents remaining. I think the best time to buy is when the stocks are down. As far as the weighted average metrics for the portfolio, free cash flow per share growth, net debt to EBITDA, and yield on cost are all better this month. Gross margin, return on invested capital, and cash conversion cycle are unchanged, while revenue per share growth was slightly worse this month. Looking forward, February has a lot of great earnings reports that I am eagerly looking forward to. Chipotle and Pepsi report on February 4th, Hershey on February 6th, McDonald's on February 10th, Dutch Bros on February 12th, Wingstop on February 19th, and Texas Roadhouse on February 20th. Given the positive reaction to Starbucks earnings, I expect Chipotle and similar restaurants to do well. On the beverage side, if Pepsi can show a turnaround, then I think Celsius will do well. Many thanks for watching. What do you think about the portfolio? Share your thoughts below. It is always great to hear from you. Please check out some more videos right now, and don't forget to put your money where your mouth is.